How small apartment investors can evaluate valuation methods for a multifamily property. Assess property-specific factors and objectives. Define investment goals. Determine if the goal is cash flow, appreciation, or resale. Cash flow-oriented investors might prioritize the income approach, while those looking for quick equity gains may focus on market comparables. Consider property type and age. For newer properties, the cost approach could be useful. For older or high-income properties, a mix of income and market methods might offer the most accurate picture. Evaluate data availability. Research available income data, comparable sales, and local construction costs. Choose methods that are well supported by available information to enhance accuracy. Apply multiple methods and compare results. Estimate value with the income approach. Calculate value based on NOI and cap rates or using DCF analysis to reflect future cash flows. This gives an income-based baseline. Determine market value using comparables. Compare price per unit or GRM with recent sales data to confirm if the income-based valuation aligns with market trends. Calculate replacement or reproduction cost. Use the cost approach to estimate replacement value, adjusting for depreciation to understand the property's tangible worth. Analyze results and make adjustments based on strengths and limitations. Compare estimates. Review values from each method to identify any significant differences. Discuss the final valuation and impact on investment decision balance methods based on priorities. Weight each valuation method according to investment objectives. For example, an investor focused on income might give more weight to the income approach, while a resale-oriented investor could prioritize market comparables. Account for risk and return expectations. Consider if the final valuation aligns with the target cap rate, cash flow, or appreciation goals. If one method indicates higher risk or returns, it can influence the decision to buy, sell, or hold. Additional tips for using hybrid valuation approaches. Consult experts for complex properties. When using multiple methods, consider consulting appraisers or brokers to confirm assumptions and refine estimates. Monitor market and economic changes. Periodic updates to hybrid valuations can help account for evolving market conditions, especially for long-term holds. Use sensitivity analysis. Adjust cap rates, GRM, or construction costs slightly to see how different assumptions affect valuation, helping to account for uncertainties. Summary. Hybrid valuation approaches give small apartment investors a well-rounded view of a property's value by combining elements of the income, market, and cost methods. This approach considers the strengths and limitations of each method, offering flexibility to adapt based on property type, investment objectives, and market conditions. By applying multiple valuation methods and weighing their insights, investors can make more informed, balanced decisions that align with their financial goals, helping them optimize both short and long-term returns in apartment investing.